horizontal account. Horizontal account. Horizontal. Yeah, what we do? Date on which date the records were entered. Particulars. स्वाति को बुलाओ अमृता साथी के फोन करो সাথী নেই এই গ্রুপে ছিল
স্যার নতুন করে জয়েন হতে বলবো
হ্যাঁ সাথীকে আসতে বলো ও আগের গ্রুপে ছিল
ওকে স্যার
If it is a ledger, then we should write journal folio JF. JF folio. Folio means page number. And then amount. Debit amount. Amount. Credit amount. Debit amount, credit amount. In France or somewhere in Rome, maybe one Italian mother actually arbitrarily showed debit on the left hand side and credit on the right hand side of a church. Because in the older days, everything was kind of the religious oriented, church oriented, temple oriented, or even masjid oriented. So they used to maintain the accounting records. And even though we had during that guy, Arthashastra, 2,500 years ago, but we got modified version of it through the Britishers amount and credit amount when the Britishers ruled our country. So horizontal account is date, particulars. If it is a ledger, it is journal folio. What is ledger? What is journal? You will know later. And in accounting, do not get confused. You are confused right now, but your confusion will go away as and when we proceed further. কি সাথীকে ডেকেছো অমৃতা অমৃতা নেই credit amount okay horizontal account horizontal account is this is called T-shaped account now. In financial accounting, we will record either in horizontal account or in T-shaped account. There is another format called report format that is for financial reporting purpose. Here, we record date, particulars, JF, amount, date, particulars, JF, amount, CR, DR. And double line, double line. See the vertical double lines. So that is why it's a reflection. It's not a reflection, it's basically reflection. What we call the prototype. Date here, particulars, journal folio, amount. Again, date, particulars, journal folio, amount. So on the right hand side of the double line, it is for the credit, and on the debit side, it is again the date, particular, journal folio, and amount. Now, what is DR and what is CR? What is DR and what is CR? Can you hear me?
Yes, sir.
Okay, what is DR and what is CR? Any idea? DR, D for debit, R for record. So we are recording the debit related stuff on the left hand side. And credit related CR is credit record. CR, credit record. DR is debit record. Okay, so we are recording credit related records on the right hand side. And this double line, vertical double line, looks like a T shape. That is why we call the T shaped account. And that is the horizontal account. Now, why do we use the T shaped account and why do we use the horizontal account? It doesn't matter nowadays, but with the advent of computers. But in the older days, the long khata, and shorter in width, right? Longer in length, horizontal account. And the wider book, okay? Shorter in length or longer in length, doesn't matter. T-shaped account. A T-shaped account is wide. All right. কে অমৃতা দত্ত দেখেছো? অমৃতা নিজেই হওয়া। Okay. Next is classification of records. Classification of accounts, sorry. Okay, classification of accounts. So there are two types of classifications. One is English approach or traditional approach, and other is American approach or modern approach. I'll go through both, but I'll suggest you to focus on the American approach because the English approach you may get dodged out or confused. So take one approach, but first the English approach. As you can see, there are two types of accounts in English approach. One is personal account and there is impersonal account. In personal account, there are three: natural personal account, artificial personal account, and representative personal account. And on the impersonal account, real account and nominal accounts or revenues or expenses account. What is natural personal account? Natural personal accounts are those accounts which are natural, means your account in State Bank of India, Jadavpur University branch. You are a real person, so your account will be in Jadavpur University will be a natural personal account. Artificial personal account, the name will be appearing like that, as if that is of a person, but it's not really a person, but it's basically companies, right? Like the Tata Steel. Okay, so it's not a name of a person, but as if it's the name of a person. So artificially, the name of a person, name of a company, or a group of any account has been shown as artificial personal account. Okay, representative personal account. Representative personal account is a natural personal account, but it's not for a single person or double person like in a joint account type of. No, it's not like that. It's for a group of persons, real persons, like the salary account. Salary account is salaries of professors, salaries of non-teaching staff, and so on, security staff, whoever the administrators. So if you club them up and record in your accounting book, that will be a representative account or representative personal account. Okay, impersonal account is not of a person. Like real account. Real account means you can touch and feel. Like assets and liabilities. What is asset? What is liability? I will come to that later. Okay. And nominal account, revenue and expenses accounts. Revenues and expenses accounts. All right. As I said, initially you'll be confused. Your confusion will go away as and when we move forward. American approach. And I'll suggest you to follow the American approach to do your accounting stuff. Assets. Asset account, meaning the asset is a property. Assets accounts are the accounts of property such as land, building, plant, machinery, stock, patents, cash in hand, cash at bank, in investment, inventories, etc. Liabilities, liability means obligation to pay. You are liable to pay. Okay. So liabilities accounts are the accounts pertaining to the obligation of the entity to the lenders, creditors for goods, creditors of assets, creditors of expenses, etc. Capital account, capital is the amount with which the business is started. It is the account of the owner who invests money in the business as capital. Okay, revenue account. Revenue account are the account of incomes and gains, right? For example, sales, discounts received, interest received, commission received, etc. Expense account, expenses are the accounts of expenses incurred and losses suffered by an entity. For example, purchases, wages, depreciation, rent, paid, rates, it should be rents and taxes. Now, in bookkeeping, there are two types of bookkeeping. One is a double entry system, another is the single entry system. In double entry system was first evolved by Fra Luca Pacioli, who was a monk of Italy. The system was recognizes the fact that there are twofold aspects of every business transaction. In order to have a complete record of all transactions, the twofold aspects of every transaction are recorded in the books of account, and this system is recognized by the tax authorities. Okay, double entry system. Actually, we follow double entry system. Single entry system, we just record only once, and generally, if you go to the bazaar, sabji bazaar, they will follow the single entry system. Okay, whatever comes in the morning, and they pay at night, or maybe in the morning itself, and at night they basically account. Okay. Double entry system is more scientific and more practical. Features of double entry system: transactions takes place only if two parties, like one party receiving the benefit, another party giving the benefit, or receiving or imparting the benefit. That is kind of the English approach. So basically, two or more parties involved in a single transaction. So we are recording both sides, okay, debit side and credit side. We are recording a debit side and credit side. The total debit and total credit should be the same for that particular transaction. Okay. Advantages. System is a scientific system of recording business transactions as compared to other systems. Complete record. Under this system, two aspects of every transaction are recorded in their concerned accounts. Thus, it makes a complete record of the business transactions because records of both the aspects are made. Check arithmetical accuracy. Since two aspects of each transaction are recorded in two accounts in opposite direction with equal amount, there will be an equal amount of debit and credit. As I said, total debit and total credit. If they do not match, we go through trial balance and try to find out the problem. Ascertaining the result of business activities under this system, as the accounts of revenues and expenses are maintained, a trading and profit and loss account can be prepared, and gross profit or gross loss and net profit or net loss can be ascertained. Ascertainment of financial position, that is called the assets, liabilities, and capital account. Okay, financial position. Disadvantages: double entry system requires expert knowledge, lengthy and cumbersome process, expensive and unsuitable for small organization. Double entry system is unsuitable for smaller organizations. See, this is the English approach. Receiver of benefit and giver of benefit. Don't go that way. You go under American approach, B. Assets account. When there is an increase in the value of the asset, it is debited. When there is a decrease in the value of the asset, it is credited. Liabilities account. When there is an increase in the amount of the liability, it is credited. When it is decreased, it is debited. Capital account. When it is increase in the amount of capital, it is credited. When there is an increase in the capital account, a decrease in the capital account, it is debited. I am going to illustrate this further on the board. Revenue account, because this is important. Revenue account. When there is an increase in revenue, it is credited. When there is a decrease in revenue, it is debited. You will automatically understand when you prepare the revenue expenses, those things, income statement, you will understand it better. Expense account, when there is an increase in expense, it is debited. When there is a decrease in expense, it is credited. Withdrawal or drawings account, when withdrawal or drawings account is made by the proprietor or partner, it is debited. Okay, withdrawn, debited. And when they basically deposit, it is credited. So, there is the table out there. Do you have any class after 3:30? Do you have any class?
No, sir.
No,
Okay,
sir.
so I'll continue. I want to continue because this topic, if I don't continue, then there may be a problem. Swati ji, aa gaye ho? Are you there?
Yes, sir.
Okay, thank you. Assets, liabilities. This is the capital. Less drawing. Drawings means either the partner or the sole proprietor basically withdraws the fund from the company. Okay, so that is less capital. So both sides basically should be equal. Should be equal. A. If you add up capital account and liabilities account, goes through. If assets increase, upward arrow means increase, downward arrow means decrease. So upward arrow is debit, downward arrow is credit. Understood? If an asset account increases, now what are included in asset account we are coming? If assets account increases, always remember there will be a debit. This is the American approach. Straight away. Benefit imparts or receiving or giving benefits, that's the English approach, you have to analyze and this, that may get confused. So simply get to the American approach. Assets, any increase means debit, any decrease means credit. Now we have to offset left hand side and right hand side we need to asset. The asset side is actually the debit side. That is why it is put on the left hand side. As per American system, as per the British system or Indian system, we put on the other side. But that is, I don't support, but that's what it is. Liabilities increase means it is credit. Opposite rule. Decrease means debit. Capital increase, same thing. Capital and liabilities, the difference between that is liabilities, you are liable to pay to the suppliers. To the suppliers. And capital, you are liable to pay, the company is liable to pay to the shareholders, the stakeholders, the owners of the business. Okay. So this is credit as well. And this is debit as well. Less drawings. So drawings reduces debit. Debit decreases credit. Okay. Net profit, net income, net loss. Net income increases, is credit. Net income decreases, it is debit. Net loss increases, it is debit. Net loss increases, it is credit. As I said, there may be confusions, but it will be clarified more and more as and when we proceed further. Any question? Where are you confused? When you deposit money, 1,000 rupees or say 1 lakh rupees in State Bank of India, Jabalpur University branch, you get an SMS has been credited to your account. But it's really debit in your book because that is your asset. You have deposited 1 lakh of rupees in State Bank of India, Jabalpur University branch. As soon as you deposit, there is a message there, has been credited. I mean, I have heard that question from various students in different departments. So it is from whose book of record you are looking at? In whose book of record? Because from the State Bank of Jabalpur University branch's book, it is really a credit because it's their liabilities. It's their liability. They are keeping your money. It's their liability. they are liable to pay. So that is credit. Their liabilities increase. Right? But in your book, it's your asset increases. So it is debit for you, credit for them. And so they write, it is credited. Any questions so far? You can take a snapshot. So that as a special, you can also look at the notebook. Any question? No question? Okay. Let us go through certain examples. If we leave more and more, there will be a problem later on in understanding. Okay, illustration. Give 5 examples of each of asset account, liability account, revenue account, and expense account. So asset account is the building account, investment account, furniture account, machinery account, cash account. Can you see the presentation here? The class notes? Okay, introduction to debit and credit. Okay. That note there. Asset account. Okay, liability account, creditors account. Who are creditors? Creditors are basically the suppliers who has given you something and you have not paid. Okay, they are the creditors for you. A loan from Madhu account, capital account, bank loan account, rent payable account. Anything payable is liability. Anything receivable is your asset. Building account. Okay. Revenue account, sales account, returns inward account, discount received account, interest received account, that is the revenue account, rent or premium sublet account, revenue account, expense account like purchase account, carriage inward account, carriage outward account, discount allowed account, interest paid account. So these are all expense account, interest paid, discount allowed, carriage inwards account, carriage outward, inward and purchase account. So check in progress, cash in hand. Explain the double entry system of the bookkeeping. Cash in hand, asset account. Cash is the asset account. Furniture, asset account. Investment, asset account. Building, asset account. Machinery, asset account. Trademark, asset account. Land, asset account. Cash in bank, asset account. Leasehold property, asset account. Goodwill, asset account. Closing stock means closing inventory, asset account. Debtors, asset account. Creditors, liability account. Who are debtors? Debtors are those things that, basically not to the main line of business. Suppose NTPC has given home loans to its employees. So NTPC is not the main line of business is home loan. So, they are called sundry debtors. That home loan receivable are basically sundry debtors. Otherwise, debtors can be the whole receivables. Okay, creditors, liability account, loan from Ram, loan from Madhu, they are all liability account. Capital account is here it is written liability account is similar to liability account treated. Bank loan liability account, Assam Company Limited a supplier liability account, Brun Kumar a customer to whom goods sold on credit asset account. You have sold any sales, from whom you have sold on credit is an asset account. Withdrawal by the proprietor personal as the drawings account, copyright is the asset account. Copyright is an asset account. Okay, classify the following account: sales, purchase, returns outward, returns inward, carriage outward, discount allowed, interest received, discount received, interest paid, etc., etc. So they have written over here. Sales is a revenue account and purchase is an expense account. Okay, first. Sales is a revenue account, always a revenue account. And purchase always is an expense account. Now, you can make a purchase asset by not showing as an expense, but periodically you can expense the depreciation, or as and when the purchase item is sold. Okay, that would be a revenue account and an expense account, cost of goods sold. Returns outward. Not every word you will understand right now, but as I said, I'm assuring you will understand it better as we go on. Outward means we are sending back. We have received certain items from vendors. Now we are sending back. That we no longer need it, or the items are defective, so we are sending back. So purchase decreases. Returns inward, revenue account. Carriage inward, expense account. Carriage outwards, expense account. Discount allowed, expense account. Interest received, revenue account. Discount received, revenue account. Interest paid, expense account. Rent paid, expense account. Okay. Outstanding salary, anything outstanding is a liability account. Okay, anything outstanding. Okay, not yet paid. Anything outstanding means not yet paid. So it's liability. Salary paid, anything paid is an expense account. Import duty, expense account. Bad debt is an expense account. Depreciation, expense account. Commission paid, expense account. Commission received, revenue account. Commission received in advance, liability account. Royalty paid, expense account. Dividend received, revenue account. So lots of account names have been given here. You will study at home, and that's how you learn. Okay. Now, let us go to a real life example. Real life means kind of assumed real life. Say, oh, anyways, you have this, right? Always this diagram, remember the assets, liabilities, which increases what, why to be debited, why to be credited. I requested you to take a snapshot. Have you taken a snapshot? Okay, thank you. Say, Swatiji, our CR, has started a business. She wants to be her own boss. Swati started a business. Swati Electricals. Electricals. With a capital of rupees 1 lakh. See, this statement for double entry system. This statement is for a double entry system. Which account is affected? কৌশিক মাঝি, তুমি মনে হয় ফটোগ্রাফ নিয়েছিলে না কে ফটোগ্রাফ নিয়েছিলে ওই ডায়াগ্রামটা, এটা ধরো কোন কোন অ্যাকাউন্ট এফেক্টেড হবে, ইম্প্যাক্টেড হবে। একটা অ্যাকাউন্টের নাম তো দেওয়াই আছে, আর কিছু নেই। প্রথমেই Swati started a business called Swati Electricals with a capital of rupees 1 lakh. কোয়েশ্চেন কিন্তু এই টাইপের আসবে। কোয়েশ্চেন এই যাবত যা পড়ানো হয়েছে সো ফার, ইউ উইল গেট ইট। Swati started a business, Swati Electricals, with a capital of rupees 1 lakh. What is the capital? So one is the capital account, right? Another is, where does the capital go? You have to balance double entry system. Where does the capital go? There will be cash account. So its answer will be capital account there is an increase in capital account or decrease in capital account. Who is going to tell me? Increase in Swati Electricals. Previously there was nothing in Swati Electricals. Just created Swati Electricals. So there was zero capital, now there is a 1 lakh of capital, right? 1 lakh increase, right? So debit, credit. Credit by 1 lakh. Another So A, double entry system. B, double entry system. Cash account, because it has only cash and capital. Cash account on the asset side, on the left hand side. As I have shown you, assets, liabilities, LIA, and capital account. Mainly, other accounts I have shown you. Sub accounts, those are sub accounts. So if this is positive, this is negative, this is negative, this is positive. Either or debit or credit. Right. So cash account, cash is an asset. Increase. Increase in asset means debit. Understood that? Capital here 1 lakh and cash here 1 lakh. Neutralizes each other. I think most of the students are confused. So what I suggest, you please go through that class note, introduction to debit and credit. And what I said, I'll give you that one, capital and then drawings account, net income, net loss, expenses. And I'll expand. Even tomorrow, I'll draw the diagram more. Okay. So you study first, otherwise it will be very difficult to understand and do the math, because this type of math will be there in the semester and the class test. So if you cannot do it, there will be a problem. So please study that small chapter, especially the later part of what accounts are included in capital, what accounts are included in expenses, what accounts are included in revenues, what accounts are included in assets, what accounts are included in liabilities. And tomorrow I will explain more and do the math. We'll do the math together. Just a minute, let me take a screenshot. Looks like, it should be participative. If there is no participation, I would understand that you haven't understood. All right. So tomorrow there are 2 classes there, and I will assume that you have read, and then I will start from there.